You've spent your whole life saving into your RRSP. But what if I told you one day that same account could trigger one of the biggest tax bills you've ever experienced in your lifetime? Most Canadians do think of their RRSP as a retirement nest egg, but really here's the truth. It's really one of the largest tax liabilities you could have in your lifetime. And if you don't plan ahead, CRA could actually be one of the biggest beneficiaries of this retirement nest egg. Let's start with what the RRSP actually is and what it's not. The RRSP is a tax-deferred account, not a tax-free account. When you contribute to an RRSP, you get a tax deduction right away, but every dollar you withdraw in the future is fully taxable as income. In other words, your RRSP is part savings account and part tax liability. And the bigger your RRSP gets, the bigger the tax bill is going to get. The goal isn't to avoid tax altogether, but it's to optimize it. Really, so you can keep more money in your pocket, whether that's to enjoy in retirement or to pass on to your loved ones once you pass away. Really, what this means is RRSP contributions equal tax savings today, but RRSP or RRIF withdrawals in the future equal tax bill tomorrow. I've mentioned what an RRSP is, but on December 31st, in the year you turn 71, you have to convert your RRSP to what's called a RRIF. Really, what that means is your RRSP turns from saving mode to spending mode, and of course, the government wants to tax that. Once it's converted to a RRIF, you are now required to take out a minimum withdrawal every year based on your age. And this is whether you need it or not. Those minimum required withdrawals also increase with your age over time, forcing even more to come out as taxable income. And if you pass away, the entire RRIF balance is taxable in the year of death, assuming you're the last to survive between you and your partner, or you don't have a partner to transfer the RRIF to. That can be over 50% in taxes in the year that you pass away. And that's often why it's called the ticking tax time bomb. Let's look at the marginal tax bracket for Ontario and federal combined to show what you could actually be paying if something were to happen to you.
If you're a retiree living in Ontario, you have $100,000 of taxable income. Your marginal tax rate is 31.48%. A marginal tax rate means your immediate additional income will be taxed at this rate. For instance, if you were to generate another $1,000 of taxable income in that year, you would have to pay just under $315 in taxes to CRA. That means you would get to keep about $685 in your pocket.
One of the biggest concerns we see of all is leaving your RSP or RRIF untouched, where your family or loved ones that you're passing it on to could only get a fraction of what the account value is today because of the taxes potentially owing or the tax liability.
Now buckle up, because here's where the ticking tax time bomb comes into play. For this example, we're going to use a gentleman named Joe, and his taxable income per year is $100,000. Joe has one child named Jane who will inherit his entire RRSP, which is currently valued at $1 million. It is close to the end of the year. Joe has received all his pension income, which includes his defined benefit plan, his CPP, and OAS. All of a sudden, on December 31st, Joe suddenly passes away. Joe is no longer at the 31.48% marginal tax bracket, unfortunately. His RRSP is valued at $1 million at the time of his death. Because he doesn't have a spouse to roll over his RRSP to, the entire market value of his RRSP is included on his final return. His taxable income is now $1.1 million. To summarize the potential tax burden on the $1 million RRSP, the estimated taxes would be $525,000. You heard that correctly. The initial $1 million that Jane would have received is actually only $475,000 after taxes. Now, this doesn't include tax credits, deductions, what province you live in. So there are many different variants that could change this figure, but this is really just giving you a general idea of what the tax burden could be with a large RRSP.
So I've gone over the not so fun potential hurdles that you could run into with your RSP or your RRIF, but There are ways around it. Should we be melting down your RSP or RRIF ahead of time before you're required to take these huge lump sums out every year, even if you don't need it? That's where the RRSP meltdown strategy comes into play. Really what we're doing is we're trying to slowly diffuse that ticking time bomb. It's about drawing down your RSP or RRIF earlier than you're required to by law. Even if you don't need the income right now, taking these controlled withdrawals could actually smooth out the tax burden along the way. So what I've done is I've compiled a handful of reasons when it could make sense for you to do early withdrawals from your RRSP or increase the RRIF withdrawals you're taking. So here's where it could often make sense. You're already retired with low income, but you have a huge balance in your RRSP or your RRIF account. Once you turn 71, you expect your RRIF minimums to actually push you into another tax bracket in the future. You want to shift funds from your RRSP or your RRIF to your TFSA, where that will grow tax-free going forward. A big one we see a lot is we want to reduce the taxes owing on our estate so we can pass more on to our loved ones versus CRA. Another scenario is you could be critically ill and your life expectancy is below the average. It could make sense at that time to actually redeem more from your RSP or RRIF. We do get the question quite frequently of, should I be taking more out of my RSP or RRIF today? And of course, every scenario is a little bit unique, so we're never going to give a blanket statement to everyone. But there are scenarios where it may make sense to not do an RSP meltdown. For some retirees, it really could be more beneficial to just leave it in your RSP or RRIF long term. So here's some of the scenarios where I think it may make sense to leave it in the RSP and avoid the RSP meltdown strategy. The first, you and your spouse expect to live for a long time. If you have longevity in your family, your parents lived to their 90s, you have a very similar health span, you're active, it may make sense to keep it within the RSP or RRIF for as long as possible to continue to defer those taxes being paid. This really just allows you to compound that growth more. So here's the next one. You need your RSP actually to grow tax sheltered and tax deferred because of future expenses like long-term care facilities and all these different expenses that could be arising in your older age. Pulling money out of your RSP or RRIF too soon and then not having enough TFSA contribution room where you have to reinvest the proceeds into a non-registered account where you're being issued tax slips every year for dividends, interest income, capital gains, which is defeating the point of sheltering the taxes to begin with. Your income is already really close to OAS clawback, where if you start now, it's clawed back now or it's clawed back in the future. So in my opinion, I'd rather have the OAS right now while I still can, especially if I'm going to be in the same tax bracket in the future. It's not about melting it down to zero. It's about smoothing out the overall tax burden throughout your lifetime. It's a balance between growing your portfolio and the future tax liabilities that you may have. There's a lot of videos out there explaining one scenario versus another, and it's really not a blanket statement where you can say for this individual it makes sense and for this one it doesn't. You all have unique scenarios where everyone's retirement picture is a little bit different. And there's so many other variables to take into consideration, like CPP, OAS, other pension income. Your age and timing of those different income sources also play a major role in if an RRSP meltdown should make sense for you. That's really why what we do at Rankin Rice Wealth Management Inc. is we look at your unique situation. We run a full cash flow projection showing each decade what that looks like, what your tax brackets are going to be, when your other income sources are coming in and what those look like. We simulate different withdrawal strategies and really look at your tax bracket in each of those scenarios to determine which one optimizes your retirement lifestyles or how much you're going to have at the end to pass on to the next generation. Our planning process doesn't look at it one time, set it and forget it. Year by year, there's going to be different scenarios where we could take advantage of an RSP meltdown or lump sums, and then other years where we may not at all. So it is going to be very unique for each individual, and the planning process is not one size fits all. At the end of the day, we're just trying to find the most tax optimized situation where you keep the most money in your pocket for either yourself during retirement or to pass on to your loved ones. My take on the RSP meltdown, I think in certain scenarios, an RSP meltdown or taking out additional lump sums from your RRIF account can be amazing to optimize your tax situation. However, there are a lot of scenarios as well where it makes sense to just keep it in the RSP or your RRIF and let it continue to grow and compound tax deferred. The earlier you start planning, working with a certified financial planner, the more control you're going to have over your taxes in the future, or what is going to actually be passed on to the next generation. If you tackle this problem early enough, there are other strategies we can implement too, depending on your age, where we can have life insurance actually cover the tax burden of your RSP or RRIF at a very low cost versus in the future. To summarize, planning more now will let you keep more later. Hey there, thanks for watching this video. If you want more information on Rankin Rice Wealth Management, look into the description below or visit our website. And if you enjoy the content, please hit the like button and subscribe. Thanks and see you in the next one.